we celebrate the great resurgence of U.S. housing after new home sales jumped to a 17-month high. Maybe not. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro, and we are going to be focused on what's happening with this U.S. housing market and whether these numbers really are as encouraging as they've been touted in the press today, and as they appear to give the devil his due at first blush. Certainly a lot of hope that maybe finally we might actually get some movement, because U.S. housing markets have been somewhat at a standstill in recent months. One might have surmised that the surge in mortgage rates might have done more to cool them, but that has not been the story. So we are going to take a look at all of the moving parts and see if we can't make sense of them and where this might be going. So let's begin with, first and foremost, a bit of stage setting. Let's get to what the price actually looks like. And this is it. You can get the waypoints here fairly clearly. So this is the S&P CoreLogic Case-Shiller U.S. Home Price Index. Say that 10 times fast. And we have marked here all of the key inflection of points over the past, let's call it almost 2 decades. There's July 2006. You can see there the beginning of a decline. That, of course, is what ultimately metastasized into the Great Recession, into a financial crisis first in 2007 and 8, and then the Great Recession that was something that the markets digested for much of the subsequent decade after it occurred. You can see that while stocks began to recover from that crisis as early as the beginning of 2009, even with the world in deep recession, housing, slow though it is, didn't finish its correction until the start of 2012. This is something that's not unusual. It is, of course, very easy to buy and sell a stock or a futures contract or an option or a currency. But actually getting markets to clear in housing takes a long time. It takes a while to buy and sell. It takes a while for supply and demand to come back closer in line. And so there are meaningful lags here. Fast forward February 2020 and the start of the COVID pandemic. And of course, you can see that there has been a significant acceleration in the pace of price gains. That's as everybody gets put on lockdown. People have to figure out how to work from home. People have to figure out new living arrangements for a world that maybe would not have returned to normal as we saw it at the time and as the zeitgeist feared at the time. Of course, we have come a good long way back now, and all the same, we're still dealing with quite a few hangover effects and probably will continue to deal with them for quite some time. But at that moment, as the lockdowns were being announced, as people were being sent home, businesses were closed, downtown areas became ghost cities, and we saw this reshuffling in what people thought their housing arrangements would now become. Not surprisingly, a rapid acceleration amid a pickup in demand. That stops in July of 2022. So you get the last burst of that just as the Fed is really starting to get going on this rate hike cycle. The Fed, of course, begins the rate hike cycle in March of 2022. 22. It talks about the underpinnings for what that cycle will be starting about the middle of the previous year. That June 2021 FOMC is where the Fed comes out and says, all right, we thought inflation was going to be more of a transitory thing than it's turning out to be. It's much stickier. We're going to need to have a meaningful rate hike cycle here. Of course, they go on to surprise markets with just how vigorous their actions end up being. But nevertheless, we still have a rise in prices about halfway into, a little bit less than halfway into last year's tightening. And that's where things start to cool. That seems to make sense, except the move never actually garners any steam. And we end up now, as of current levels, about 1% off that high, having attempted to work our way lower, rebounded, and now kind of in standstill, kind of in a holding pattern. Now, why aren't these markets moving? Well, a lack of turnover certainly seems to be a big part of this story. Now, this is where today's data ought to be taken with a bolder-sized grain of salt. Yes, new home sales rose to a 17-month high. Let's have a round of claps for that. Also, new home sales are maybe dwarfed by a factor of 6 by existing home sales. So when we look at total home sales in the United States, it isn't new home sales that drive the car. It is existing home sales by a wide margin. And what we see here is that the turnover is woeful at this point. We are down to essentially the pandemic era lows for turnover. Consider here, this is the start of COVID. This is before the surge of buying that we just saw on the previous chart give us that run up in prices. This is the initial lockdown where sales collapse. We are basically at those levels now, which are themselves about a 12-year low on overall sales. And it's the absence of activity on the existing home sales side of things that really matters here. New home sales are a drop in the bucket. Now, why are new home sales a drop in the bucket, and why aren't existing home sales having any activity? Let's start with the latter first. Does anyone want to take out a mortgage if they already have one? Well, the short answer seems to be an emphatic absolutely not. The effective rate on outstanding mortgage debt is only about 3.6%, whereas the current mortgage rate on a 30-year fixed home loan, the national average anyway, available in markets currently is 7.6%. So there's a 400 basis point difference. Now, if you've locked in a mortgage at 3.6, how much of a seller are you going to be? Ostensibly, you do need to live somewhere. And so if you are selling with the intent to then move and buy something else, what you are then buying, you will finance 400 basis points more expensive. I think it doesn't take a whole lot to figure out here why supply in the existing homes space is so limited. Folks are almost certainly doing everything they can to avoid reneging, having locked in such low mortgage rates relative to what's available in the market currently. And so, not surprisingly, there's not exactly an army of sellers out here to get the turnover in the existing homes space moving. But actually, it's a bigger story and a deeper one. Inventory of existing homes has been falling since, drumroll, 2006. Now, what do we know about 2006? Well, as we just saw here, the rise in house prices that ultimately crested and that gave us the financial crisis culminating in the Great Recession, that rise in prices crests in 2006. What an interesting coincidence that this is also where inventories crest. And of course, that ought to make perfect sense. Why did prices start to fall? Oversupply. Inventories had jumped, as we can see here, to just below 4 million. Not surprisingly, that's a very meaningful overhang unless it is being absorbed. And we got to a point in 2006 where it was just too much supply relative to demand. Economics 101, if you will. In subsequent years, that inventory had to get worked down. It had to it had to get worked down through a recession, through years of balance sheets being rebuilt by consumers, which got burned in the crisis, years of anemic growth, years of negative real wages because interest rates were so low and inflation so weak. And so you end up being in an environment where the inventory of existing homes has gone nowhere but down for the better part of 2 decades. And certainly you can see there's areas of acceleration and deceleration here. So, for example, you can see that the initial digestion of the crisis, the decline in inventory is a bit steeper. There's a bit of a digestion here. And then as you get into COVID era, the decline in inventories accelerates again. It has been a little bit more anchored recently, but with only 1 million homes in inventory, it is, needless to say, at major lows. There just aren't supplies. And so the market is at standstill. Mortgage rates are high, so nobody is trying to really take out a new one, having already locked one in at a much lower rate. And in any case, supply has been going down for quite a while as we digest the overbuilding from the last cycle. Now, that explains why the housing market appears to be at a standstill. So where to next? Well, we are seeing some interesting developments recently. And it's not the new home sales number, although that might be part of it because, of course, in that people are, in fact, buying new homes, we get the sense that there is a contingent of buyers out there. It's just not a very motivated one when we consider that there is 1 million homes in existing inventory and only 700,000 and change of new homes were purchased. So there is still clearly not enough here to really move markets. But needless to say, the new home sales number does suggest that there exist buyers, just not at the scale that would actually move markets. Because surely if the total stock of sales, as we just looked at, is under 5 million, and if we were to even get to relative recent history, let's say around here before the pandemic at about 6 million on average, we might be looking at a bit of a different story on the prices front. So let's consider what might be next. The green shoots that appear come from housing starts. Housing starts here are actually showing some signs of life. So we have most recently, as of July, a rise of 5.9% year on year, even though the actual aggregate number of housing starts, that's the yellow bars that you see there, is still relatively low at just over 1.4 million. You can see it's been declining since about the beginning of last year. Not surprising, of course. Builders are not exactly keen to go and start building into a rising interest rate environment because, of course, that rising interest rate environment might be expected to hurt demand. So why would a developer that takes about 7 to 12 months to build a new single-family home, according to the U.S. Census Bureau, why would that developer want to be ramping up output at the beginning of a rate hike cycle? That doesn't seem to comport. Instead, you can see the yellow bars here get lower over the course of last year and into this year. There's been a decline. But that decline may be turning a corner here. So we can see that housing starts are starting to pick up, but more importantly, that the rate at which they're moving is starting to meaningfully accelerate. That's quite a pop there at 5.9% relative to history. And so when we consider what this means, it might be the beginning of the end for this standstill in housing prices, and the direction for it to correct might well be lower. Now, this is just the beginning, and so we need to proceed with caution here. As we said, housing markets are notoriously slow. They take a long time. But if housing starts are indeed starting to turn a corner and accelerate, that means that in 7 to 12 months, we should have a bulge in supply of new homes coming to the market. That might suggest a degree of downside pressure, at least on the price of new homes. And as we said, new homes are not the big part of this story. But if there's enough of them built, and if momentum accelerates, well, then maybe there will be a different balance of things that develops over time. But nevertheless, it is existing homes that have to move. And here the story gets even more interesting. Now, why is it that we're getting this pickup in housing starts? Well, they started to get clawed back, as we just said, in anticipation of the Fed raising rates. Well, now the market thinks the Fed may be done raising rates. And if they were looking for a rate hike cycle last year, and so by the beginning of the year, they were already reducing supply, then maybe at the beginning of this coming year, as a rate cut cycle starts to appear on the horizon, increasing supply starts to look viable, because if you're a developer you're going to want to have homes to sell when mortgage rates have started to come down and buyers maybe have started to dip their toe back into the market. You likewise have, as ever, a forward-looking set of financial markets that doesn't need to see this happen to begin to react, but needs to anticipate. And so the prospect of more coming on steam, the prices of mortgages, hopefully, from the perspective of buyers, starting to at least get anchored and maybe even start to flirt with a reversal in the opposite direction, that might well give another nudge lower to housing markets. And if it does, then perhaps some of these holdouts that have been waiting to sell in the existing homes space start to come off the sidelines. And if that occurs, well, then there's a very different supply story that we're dealing with. Here's what the Fed outlook looks like. And of course, take this with a grain of salt because we have the Jackson Hole Symposium ongoing as we speak, where the great and powerful Fed chair, Jay Powell, will speak tomorrow in a very highly publicized, much anticipated speech. We'll talk about it on Macro Money on tomorrow's show in exhaustive detail. But this may very well shape these expectations in a meaningful way. But as it stands currently, rates are at about 5.4%. They're expected to hold here for essentially the next 6 months. We are then looking for the start of easing at some point into the second quarter. You can see that within a year's time, we're down by about 50 basis points, a little bit more. And by about 2 years' time, we've shaved off closer to 125, 150 basis points. Now, again, this is housing. It is slow. So 1 and 2 year time horizons are very much par for the course. If the Fed is in fact done raising rates, and there are in fact rate cuts that then begin to bring down mortgage rates, those rate cuts come into play on current reckoning by May or June of next year. So the probability of a rate cut now about 62% for May, but that cut is fully baked in at this point by the June meeting. There's a second cut that's fully baked in by September, and a third one that's fully baked in by November. We have a 76% chance of a fourth cut by December of next year. So we're looking at rates for next year ending at about 4.4%. We're currently in the 5.25 to 5.5 range, so that amounts to a 100 basis point come down from where we are now to where we end next year, give or take. There's about a 47% chance, it looks like, that we are going to have another rate hike this year in November here. You can see that in the number hikes / cuts column there, the second column from the left. And again, these are cumulative percentages. So if you then look at the percent hike cut column, you can see there's a 16% chance of a hike in September, and then a 31% chance of a hike in November. So the cumulative probability of a hike by November is 47%. So just about 50-50. And again, we'll see how Fed rhetoric alters this. But as the markets look, and if this holds up, and as we start next year looking at a rate cut cycle, we might start to anticipate lower mortgage rates. Folks that might have waited to sell because mortgage rates were going up and they didn't want to attempt to borrow into a rising market, well, maybe they might consider, knowing that it has started to reverse, and at the very least, rates won't be any higher, at least in this cycle. If you get, on that basis, a bit of activity in existing home sales, and you add into it a bit more vigor on new home sales on the supply side, because housing starts are picking up and maybe there is a bulge of output that comes sometime mid to late next year, maybe the price starts moving lower, and that becomes something of a motivating factor. Those people that are holdouts and haven't sold maybe start to think about it and start moving on it, which of course brings still more supply and drives the price still lower. So the dynamics here probably not favorable for any kind of break in the narrative tomorrow or the day after that. As we say, housing is slow. But the possibility that this standstill resolves lower seems greater than it resolving higher. And the timeline for where it could begin to really roll over seems to point toward the back half of next year as the time when housing starts to perhaps really get a little bit of significance on the downside, as more turnover and more supply, both in existing and in new home sales, enter the picture. And that is Macro Money for today. We're here Monday through Thursday every week, right after Overtime, a show that I do with Chris Vecchio, head of Futures and Forex here at Tasty Live, where we figure out what happened in markets after the Wall Street close and attempt to surmise where things might be going next. I'm back on with Chris on Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and issuing pithy, smart, and not very smart comments on Twitter at Ilias Pivac. That's right, on Twitter. Thanks very much for joining. See you tomorrow.